All right, like I said, this is going to be recorded, and one thing I say at the beginning of all these webinars, watch this again as soon as you guys get this webinar in your email or whatever, because it'll make it really sink in, especially if you are new to options or this type of strategy. Watch these videos over relatively soon after watching this webinar, because it'll really make it sink in. If you wait several weeks down the road, it's going to be like relearning again. The first time it goes through. Does everybody else think the sound is okay here? Got a couple of people saying the sound is poor, or one person saying the sound's poor. A couple other people said it was okay. If you could hit me up in the questions box. I'll just try and talk a little bit louder maybe. So one thing I say is watch this over again, because it'll really make it sink in. If you wait several weeks down the road, it doesn't stick. The first time through, it goes into your short-term memory. If you watch it again, it makes it go into your long-term memory. So just, with that, going forward, keep that in mind. Try and watch these again relatively soon. Sorry, Jay, I think it sounds good to everybody else. I'm not sure. I could be getting a little feedback from the room that I'm in, but for the most part, I don't know. All right, so this is going to be a strategy that's great for market sell-offs. In hindsight, being 2020, maybe we should have done this last week, but at the end of the day, there's always a possibility for the market to sell off, and I'm not even necessarily sure that we've found a bottom yet. So it's still going to be relative to what's going on. Plus, anytime you have an overall portfolio, usually that is really geared towards the long side. So this is going to be a way to protect a portfolio on the downside at any given time. Anyway, so moving on, my name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal, where I've commented on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these webinars is not really a solicitation to buy or sell any of these securities or strategies. But I've been trading my own money for 20 years now, and I'm not here to tell you that I'm going to make you rich or that I'm going to make you a millionaire, but I am here to help you take control of your finances, manage your own portfolio, and most importantly, manage your own risk. At the end of the day, the money you guys are paying to a financial advisor or to a mutual fund is embedded into those different strategies, and they may not perform, but those guys are still getting paid. So if you guys aren't performing, at least you're paying yourself. You're paying for your tuition. At the beginning, you may not make money right away, but it will eventually be able to make money doing this yourself. I mean, a monkey really could do it. And I've traded in most markets throughout my career. From the Chicago Board of Trade, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all those products and in all market conditions. I got a disclaimer I've got to go over here. Basically, this is just saying any opinions, news, research, analysis, and other information contained here or provided by ProTrader Strategies or associate companies is for general commentary. The reason why we can't give you specific advice on what to invest in is because we don't know your risk parameters. We don't know what's in your portfolio, so some of these things could be counterintuitive to what you're already doing. So what we're trying to do is to teach you how to swim, not really swim for you. Because at the end of the day, I wouldn't be able to know if it's appropriate for you unless I really dug into your portfolio, learned a little bit about you guys and your risk parameters and things of that nature before I could give you any type of specific advice. So I can tell you what I would do in a given situation. I can't tell you what you would do because I don't know those details. So at the end of the day, the bottom line is do your own homework, and please remember that past performance of any trading system or methodology is not necessarily indicative of future results. I'm sure you guys have all heard that before. All right, so this is going to be an option strategy using long put spreads. And if many of you guys watch these daily market commentaries or even the webinars, you guys know that I'm specifically into selling premium. That's my main strategy. That's my main go-to. But there are different situations where a long put spread is definitely a good strategy to implement into your portfolios. And I'll show you when that will work out for the best. And you also want to have a lot of different strategies in your portfolio. You don't want to just have iron condors in there. You don't want to just have one specific strategy all the time. You want to have a lot of different ones in there to just take advantage of different market movements that you're not ready for, whether it's volatility expansion, volatility contraction, theta decay, and things of that nature. So that's why it's really important to have a lot of different strategies in your portfolio at any given time. So for some of the newer people that don't really know what a long put spread is, you're buying an in-the-money put, which is above the market. So if XYZ is trading 50, you're maybe buying the 51 or the 55 put, and then you're going to sell an out-of-the-money put. And why would we sell the out-of-the-money put? A lot of times when you're buying, every time you're buying an option, I should say, your risk is limited to the premium you paid for it. Well, as I mentioned earlier, I am a premium seller, and I don't like to really pay anything for these different options. I like to get paid for them. So if I'm going to pay money for one of these, I want to at least finance it a little bit. And I'm going to finance that by selling the out of the money put. And what my idea behind this is to only pay for the intrinsic value of that put. Now let me go over real quick what intrinsic value is and extrinsic value. Intrinsic value can only be found in an option that is in the money. And that intrinsic value is basically the difference between the strike and what the underlying is trading at. So if XYZ is trading 50 and we have the 51 put, then the intrinsic value is about $1. So that option may be trading for $1.25. The intrinsic value of that option is $1 because that's the difference between the strike and where it's trading. Does that make sense to everybody? Intrinsic value is kind of what makes the strike equal to where the underlying is trading. That's the intrinsic value. Extrinsic value is the time that is embedded into those options. So there's a premium there for time and time decay. They will fluctuate with volatility and things of that nature. Volatility will pump up premiums, and that is all a part of the extrinsic value. So out of the money options have no intrinsic value. They are only extrinsic. And it's a bear put spread. Whenever we're getting long a put spread, it is a bear put spread or a debit put spread. And our idea behind this is bearish. Market neutral is one thing. You know, you can take advantage of that option decaying out of the money, but really it is a bearish assumption. When we want this market to go down, we don't really want it to go sideways. And we definitely don't really want this to go up on us. That we don't want the underlying to rally, I should say. So we're always going to end up paying a premium. But with this premium, we're going to try and keep it to where we're only paying the intrinsic value of our long option. Right? And I'm going to show you guys how to go through those steps and figure that out. But we're trying to keep this to where it is as close to just paying for intrinsic value or the real price of that option. And time decay, we want to take advantage of some time decay here. And I'm going to show you how you can take advantage of some theta decay in these options. It's sometimes it doesn't always work out, but sometimes that it will, and I will always try and make that an effort to make sure that we can try and take advantage of some theta. And volatility, with this strategy, it's okay to have it to expand because, you know, anytime the market sells off, you're going to get volatility expansion. So volatility expansion is not really going to hurt us. Obviously, anytime you're selling any options, you would like to see it contract a little bit and have some of those premiums come out a little bit, but it is okay to have it expand. And I'll put, anytime you're dealing with puts, anytime those puts are going your or the market is going in your direction and you have puts, your long puts, volatility is likely going to expand, because anytime the market goes down, that is usually when you see volatility expand. Volatility is really just an expression of fear in the market. So as volatility increases, that really is an expression of the overall market being a little bit fearful of the downside. And the keys or the essentials to success, I always go over these because these are something I go over every single time I do any option strategy. Every time I look at it, I'm trying to pick the right strike for any particular strategy. And like I said, picking the right strikes, this has to do with what I mentioned or touched upon earlier. We're going to try and only pay for intrinsic value. All right, the extrinsic value is the time decay, and that we know is going to happen, but we don't want time decay to really affect us to a great degree. So we're going to try and limit that time decay by paying for intrinsic value only, and picking the right strikes is key to figuring that out. And usually the higher the delta you're going to use, the more bearish you are. So the more deep in the money you are, the more bearish you are with that underlying. And I'm just kind of breezing over these slides so that we can get into the platform. So I'll show you in detail on the platform. And we're going to be trying to pick the right duration. What's the right duration for these? For selling option strategies, I always look at inside of 45 days. With these, I'm going to be trying to pick, right around that 45 or more. I don't want to go really far out, but I do want to be a little bit outside and further away from expiration. So I'm not going to be picking like an 8-day or 10-day or anything like that. I'm going to be trying to shoot for above 40 some odd days to expiration. And the reason why is because we're long the in the money put, and that's going to have that theta decay happening. We don't want it to happen really fast unless we can structure this so that our short put, which is out of the money, will decay faster. And if you find that happening, then you probably would want to move inside of the 40. If you can't get that theta to happen in the out of the money faster than the in the money, then you would want to pick further out. Does that make sense to everybody? If our in the money option is going to decay faster than our out of the money option, we want to go further out. If our in the money option is going to decay slower than our out of the money option, then we're going to want to move it into here, because we want the out of the money option to decay faster the closer we are to expiration. All right, so in picking the right environment. So the right environment is, you don't want to really put this strategy on near bottoms in the market, for the most part. This is a strategy we would want to put on when we're at historical highs for the most part, or in a bear market, which we are starting to turn into a bear market here. So picking the right environment on this one is going to be important, in that don't do it when everybody's saying sell. You want to do it when everybody's saying buy. I'm a contrarian by heart, but at the end of the day, when everybody's saying sell, that's usually when there's capitulation happening, which means that's at a very near bottom. And picking the right underlying. This is extremely important, you guys, because anytime you're dealing with options, if you're dealing with an underlying that doesn't have a lot of volume and open interest, that bid ask gets wider. So even like in Yahoo, which used to be a really highly traded options contract, it's kind of fallen out of favor. And those bid asks have gotten really wide. I mean, I was looking at the options chain today, and I think it was, just for the February contract, which you'd think there would be a lot of interest in there, that the bid offer was about 25 cents. So if the bid offer on one particular strike is 25 cents wide, you're dealing with a strategy with multiple legs that keeps getting further and further apart. So if I'm going to buy one and sell the other, we're looking at almost a 50-cent spread there, right? Because the bid ask on the one is 25 cents wide, the bid ask on the other one's 25 cents wide. So essentially, to get in, to get out, I'm looking at easily 50 cents of leeway there. And for an options trader, you don't want that, because that means you have to give up a lot more edge to get in and get out. So we want to pick something with a tight bid ask, a lot of open interest. Some of the bigger names like Amazon and Google, those have wider bid ask. Those are very expensive stocks also, so you would expect that. But a lot of times there's so much open interest in those that you can bid 5-10 cents over the bid, and you're going to get hit because there's so many players in there constantly moving around. So keep that in mind. Make sure you're not picking a underlying that your cousin told you about. He thinks is a good stock or something like that. Make sure at the end of the day that there is a lot of open interest and volume in any underlying you choose. And know your exit strategy before you enter into the trade. With this particular strategy, I always look at it as if my short strike is breached, I go to cover it. Whether I'm at max profit or not, when that short strike gets breached, I'm getting out. The reason why I do that is because there's a probability of it being in the money and a probability of it just being touched. So the probability of my strike being touched is twice as large as my probability of it being in the money at expiration. So your chances of it getting touched are a lot greater than it being in the money. Therefore, I play the probabilities. If it gets touched, I'm out. Does that make sense to everybody? You're half as likely to be in the money at expiration as you are of it just getting touched. So you might not get your full, $2.50 or whatever on your max profit. You might get $1.25, but to me, taking that $1.25 and running once I get touched is going to win more often than trying to wait it out and get that extra $1.25. No, that's not exiting at a loss, Peter. That would be just if I'm long, so XYZ is trading 50. Let's say I'm long the 55 puts and I'm short the 45 puts. As soon as XYZ trades down and hits 45, if it does, if I'm lucky enough for it to do that, say within 3 or 4 days, or maybe even 5 days, as soon as it hits 45, that underlying hits 45, I'm out because it's hit my short strike. And I'm probably going to capture a large amount of my max profit. Does that make sense? Usually if it rallies immediately against me and tests my long puts or whatever, I'm going to just let that all expire. So this is going to be one where, because I'm long the option, I'm going to hold on to it. If it goes through my long strike or my in the money option, or my in the money options go out of the money, I'm just going to leave it and let it all expire. Sometimes I might go in and buy some stock or something like that to counter hedge that, or maybe buy some calls or something like that for a little bit of risk management. But for the most part, I'm going to kind of move on with it. All right, so our max profit is really easy to figure out with this, you guys. Max profit is your long put strike. So in the case of XYZ that I just gave, is the 55 puts, and my short strike, which is the 45 puts. And if we collected, say, $5 for that, our max profit is $5, because $10 wide there. My premium was $5, so it's a max profit of $5. Does that make sense? Phil's asking, do I wait a certain time after the market opens before I start to trade? That kind of all depends on earnings trades. I try to do earnings trades within the 15-30 minutes of the open, always. Hard line on that, actually. But for the most part, I'll wait to see those bid ask tighten up. I've kind of been in for a little while in the markets for a while, so I'm pretty used to where the market should be trading. For any given underlying, like Yahoo being 25 cents wide, or Apple being a couple pennies wide. Apple, usually I will move into those rather quickly. But I do usually wait about 30 minutes, let everything kind of settle in, and get the participants in there, get the market direction, things of that nature. That's something I've always done, is kind of hold off for about 30 minutes after the market's open. Does that make sense? I always hedge all my debit spreads and notice I get screwed too easily. That's true, awesome. And that's why I said, rarely will I do it, but every once, if my thought process has changed, like if I changed my idea of it, then that's when I would go to get a little aggressive with it. But usually, you're right, I'm kind of pulling the plug. If I change my idea, I pull my plug on that option strategy. And I can go into tons of examples of me pulling the plug on a particular trade when I change my idea. And then the max loss is the net premium you paid. Anytime you're doing a debit spread or you do anything for a debit, that's your max loss. And your break even is going to be your long strike minus your net premium. All right. So that's pretty self-explanatory for the most part. All right, so let's get into the options, or onto the platform anyway. So in this, I usually, for this strategy, like I said, anytime the options go down, the implied volatility percent, which is what I always look for right here for any option strategy, that's going to probably go up. Now, if it goes up or down with this strategy, because you're long an option, you're short an option, is all going to kind of depend on where the, probably should have something else up here so I don't have 1,000 different. So let's go into, let's see, IWM or something. Craig's asking, would I do this strategy with a stock that I might want to own? No, I don't usually look at it that way, because the reason being is because you're a defined risk strategy here with this. So I'm not going to, in order to do something like that, I would probably end up having to leg out of one side of the strategy, and I usually don't do that. So with this particular strategy, I don't. On something like that, I would probably just sell a put or something like that, and maybe hope that it gets put to me. So with a defined risk strategy, I'm just looking for a market direction and don't really want to own it. And I'm looking for it to happen relatively quickly too. So it's usually when I see it like come to a top, it may be like a middle of the road, like after a correction or something like that, and the market has made a top, come down, back up again. That's usually where I'm going to look to do this strategy. It hasn't made a new high, but it's kind of made a rebound. It made a new high. It looks like the longs have covered, and then all of a sudden it's kind of made a little bit of a bounce, and we used to call it a dead cat bounce on the floor. It means you get this drop and you get this bounce, about halfway back up. That's usually where I'm going to do this strategy because, it could easily go up and test the highs, or it could have that dead cat bounce and really fall off. So I want to be a little bit protected here in case it, goes a little bit higher, but I think it's going to kind of fall off. So I don't usually do this strategy with something that I really want to own. But that kind of goes for just about any time I don't really want to own the stocks anyway. In my eyes, when you're owning stocks, you're really tying up a lot of margin, and I would rather have that margin and use it as and being able to leverage it, several times over. So that's why I look to do this. I look at implied volatility. I look at implied volatility over rather than I guess historical volatility is your HV. I almost never look at historical volatility, to be quite honest, Nick. I just look at the implied volatility percent for the most part, because the implied volatility percent is a ranking of where volatility is. It is on my charts. I just haven't gotten rid of it on some of them, I bet. This is the implied volatility. I don't have the historical on there. They do have a historical one, but so the reason why I look at the implied volatility percent that I was talking about on the options grid right down here is because what that 53% is saying is that when it's trading at 28 or 0.28, that's right at the middle of the last year's high and low for the most part. So the percent, the way they come up with this math on this is the 28 where it is now minus the low, which is 15, and then that's divided by the high minus the low, and that's where you get your percent for that. Does that make sense? So right, what this is saying is 20 or 0.28 is right at the middle of the high volatility and the low volatility over the last year. So I would be looking at, I only really look at this. And with this particular strategy, I'm not as concerned with the implied volatility percent as I would be with maybe the long call spreads, just because going into it, I know volatility is going to expand with this one. So I'm going to try and set it up when I go into the trade page to make sure that my volatility, my Vegas on this particular one are going to kind of line up. I want to try and get my theta decay to happen more than my than the in the money option. So for instance, with this one, I would probably look at doing the 108. So I'd look to buy these 108s, and then I look across. So the 108s, when I was talking about the intrinsic versus the extrinsic value, this is kind of a quick and dirty way to figure out what the extrinsic value of the 108 options is if you just go straight across, it's about 150. It's, it's probably closer to 170 or something like that, just eyeballing it. It's 103.85. So if you subtract 5, you're getting 103.75. So yeah, you got about $1.50-ish in there. Does that make sense? So it's so Nick, I look at the current implied volatility, and then I figure out where that is in relation to where it has been over the last year. So, and what that is the implied volatility percent right there. That's where it is now in relation to where it's been over the last year. So it's just above 50%, which means this is just above, it's in the upper half of where its own implied volatility has been over the last year. Now, if you remember these August spikes, another thing I do look at with this, and this is the reason why it's important to know this math, is because that's a huge outlier, right? I mean, it hasn't done that in over a year plus. So that one should probably be able to get discounted. So the reason why it's important to know the math, okay, you have a numerator and a denominator, right, in a math problem. Numerator's on top, denominator's on bottom. In the numerator, we take this 28 minus the 13, so that gives you 15, right? And then you go to the top, and 40 minus 13, what is it? 40, is that right? 43 or 40, yeah, 40 minus 13, and then you divide those by each other. And that seems like it would be more. But the reason why it's important to know the math is because I could take that one spike out because it just doesn't happen often enough. And I could easily say that IWM is at the high end of its volatility range, right? So its IV percent is probably much higher realistically because the math is taking into account this. But if I take that out and I say 28 minus 13, so I've got 15 divided by 15 divided by 17, 18, 15 divided by 18, that would be much closer to 90%, right? Does that make sense? Phil, you're saying that you notice that the grid sometimes different from the market bid-ask price. I don't know really what you're referring to there, though. I mean, sometimes you're not going to get filled on the bid, but you will almost always, if you hit the offer, get filled. Does that make sense? So in this, what I was talking about with the theta decay is on a situation like this. So the deltas that I look for and I start with is right around 64-ish. And I go up to about the 84. 84 is one standard deviation away. So if I'm more bearish, I'm going to move more deep in the money. And the deeper in the money you are, the less extrinsic value you pay. So you can get further away. And it's definitely more aggressive. But for this particular one, let's just look at it from this standpoint because I want to show you that to make sure that we see this is that it's not going to work out on this one. So I'd probably bump it up to the 109s because I start out the 64. And the reason why I would do that is because I'm looking at this theta decay right here. So we got -4 theta decay, and that's what this option is going to lose 4 cents a day. Okay, so I would rather lose 4 cents a day in the option I sold because I want the one that I sold to decay really quickly, right? So I would try and buy something. If I was looking at the 64s, all of a sudden I would be like, okay, well, I can't sell these 107s. I pay extrinsic value of $1.96, so I would go straight down here and think, okay, I've got to at least collect $1.96 because I want to get out of all of my extrinsic value. Does that make sense? My extrinsic value is the time decay. So if I can sell something for $1.96, my theta decay is actually the same because this 4 cents, 4 cents. So those are going to offset. So I would probably go, you know what, I'm going to go up to these 109s because now my theta decay, if I go up to the 109s, I only have to collect $1.26. So I can sell the 97s or the 96s and get more theta decay than what my long is decaying. Does that make sense? So these 97, 96s are going to decay a penny faster a day. And if volatility comes out of those options, that's going to decay a lot faster. But at this point, I'd be looking at the theta decay for that. So that's where I start that strategy. I started like the 64s. It usually ends up being somewhere up here in the 70s because 70s or even the 80s, because that's when I can get the theta to start having a discrepancy. But the real important takeaway here is that when we're selling this, or when we're buying this option that is in the money, we glance over because the calls are going to show us very closely to what our intrinsic value. You can do the math exactly to figure it out, but we want to know what extrinsic value is of this option and then try and finance that extrinsic value by selling the option out of the money. That has all extrinsic value. There's no intrinsic value in these because they're out of the money. So if I sold these 108s here, I don't know why my cursor won't move, the 108s here, I'm going to try and at least collect $1.60 for that. So if I'm selling the 108s, I'm going to try and collect $1.60 for that strategy, which is probably these 98s. And as you can see, then my theta decay is -4 and my theta decay is -4. Shoot. So I would then go to the 109s and say, okay, well, theta decay on the 109s is -3. I'm going to try and collect $1.26 for the 109s. So I'd go down here, $1.26. I could probably get those 96s for $1.26. So it would be a pick 'em. And if I wanted to lower it a little bit more, I'd go with the, make sure I'm only paying intrinsic value for it. I'd probably sell the 97s. And as you can see, I would get a penny more in theta decay a day. Sorry, Homaro, no one's ever told how to pick options like? All right, I've got a bunch of questions coming in, it looks like. Or it's filled at the price that is lower than the bid price, but it is to my advantage. Wait, you place an order and it's filled at a price that is lower than the bid price? Are you saying that you bid for a price and underneath the market fill? Oh, that's the algos. I haven't really ever noticed that actually, but if you're doing well with that, I'd stick with it. Are you picking a particular trading house, or are you? All right. I'd like to talk to you about that further sometime actually, but let me get on to some more questions. What do you use for market direction for debit or credit spreads a month and a half out? Are you asking what kind of charts do I use, Fred, for directional trades? And how do you pick which equity to use for a credit spread or for a debit spread? Good question. How do I pick which equity to use for a credit spread or a debit spread? Usually the higher the implied volatility. Can you guys all see this left side here? So I put this in my options, or in my market watch list, and this is the IV percent. Let me see if I can move that over and it'll do it. No. So this is the IV percent. That's what I was talking about. That's this calculation that we were talking about. Excuse me. and that is what is at the bottom here. That's that IV percent. So that's showing up over here. So if it's at 100, all of these, I can tell you right now, I would be selling option strategies against them. Now, selling iron condors if I didn't have a market direction. There's so many different ways that I come up with my bias on which way I think the market's going to go. It's usually gut, and I just kind of look at the charts and figure out if they've gone through support and resistance. I also look at this right here, which is the market profile. Anytime you get very far away from the point of control, which is where the most time and volume has been spent, so that's where the overall market perceives value, is right there. Anytime it gets too far away from that, it means basically the longs are covering, the shorts, are, selling more probably. So it's always going to want to kind of migrate back to this. It's going to push back and forth and kind of have this whipsaw, but anytime it gets to market extremes, I'm always looking for it to come back to there. Does that make sense? Oh, thanks, Amaro. Nobody's ever explained it like this. Appreciate that. So another question, how do I determine diagonal spread, calendar spread, debit spread, credit spread? Again, what I'm going to look at is several things. And I kind of go into this in all of the webinars individually, what I look for that particular strategy. So that's something, I could probably take up too much time for, but, if I'm looking for volatility to expand, say, and I'm pretty sure volatility is going to expand, that's probably when I'm going to be doing my, my calendar spreads, okay? If I'm going to be selling options, I'm going to be looking for volatility to contract. So for Yahoo, Win, I'm going to be short strategies in almost all of these. Whether it's short a call spread, short a put spread, short a naked put, whatever, short a iron condor, short a strangle, I stay away from the straddles and the iron butterflies. I like to take my strangles and put them on, and then I like to be able to turn those into a straddle or turn those in an iron condor into an iron butterfly by rolling them down. Get defensive that way. I like having that option of being able to manage those that way. So I stay away from the straddles a lot. They have lower probability of success, but you also, there's a lot more reward in those. But I just something from the floor, I always hated straddles. It just seem like they're very hard to win with, and so I've gone with the other ones. But the way I look at it for a strategy like this would be something, where you had this bounce like this, and I hate using hindsight like this, but where you get a bounce and it tries to recover, this would be a point where I would be looking to put the strategy on. Even right here, you kind of rally, you pop down. Right here, I probably wouldn't because it made a new high. It came off of this, so it found support. So those kind of things I probably wouldn't. The fact that it had a triple top here, I might think about it. But I try to do this strategy when I see a move like that. The other thing is like with that, here's a couple of examples that I was actually looking at for this particular webinar. I'm bearish emerging markets right now. I don't really see emerging markets doing that well. Yeah, it's at a historical low in this ETF, but I don't see anything happening. So this would be a place also where I would put on this defined risk strategy, where I know what my limits are. I would go to the options strategy. I've got an idea. I don't think that emerging markets is going to do that well, but I also don't want to get run over with it. I think the implied volatility is pretty high. It's at 100%. So all of the things, I would like to see implied volatility go down. So this might work out. I'm not as concerned about the implied volatility percent in this, other than I would like to have a bias for it to go down. So in this regard, I would look at something like I think I was looking at, before it must have popped a little bit, I think I was looking at the 31. So let's look at the theta. So I got a 3 theta here. It's a little wanky because market's closed. That theta is probably 3. Those are probably 3s there anyway. So I'd probably look at something like the 30.5. If I wasn't worried about the theta, I could go 30.5. See that I'm going to get, all the bids and offers are off on this now since the market's closed. They're really wide Friday afterwards. So I would, look at trying to pay for my intrinsic value for that. This is not a very good example, especially right now. Need something where everybody's left their bids in. See what, and XOP. So XOP, I just read, I've been talking about this as gas is going down, the companies can't afford to do exploration, right? North Dakota is just falling apart. The banks are starting to crimp the credit facilities on some of these companies up there because they know that with oil going down, their assets are going down in value, and these guys are hurting. They're losing money if they're trying to get anything out of the shale oil fields up there. And so I would be bearish on this as well. And it is also at a historical low. But having said that, I want to be protected on the upside, so that would make this a good strategy for this. What do you say? How far do I let the position move against you before getting out, or do you let both sides expire worthless? Nick, if it's going against me, I usually let it go, and I cover it almost as soon as the market has breached my strike that I am short. So if I'm long the 30, short the 25s, as soon as XOP goes 24.99, I'm looking to cover this. As soon as the underlying is trading at 24.99, that's when I'm looking to get out. If it's 1 day, 10 days, 15 days, that makes sense. I usually look to get out as soon as my short strike is breached, because the probability is like I was talking about. So the delta is kind of the idea of the probability of being in the money or out of the money. But the probability is twice that. So here, to make it easier. So probabilities of being out of the money is inversely related to that number for the most part. So the probability of this being in the money or being out of the money at expiration is 20, 21, let's say. Probability of it being out of the money is 21. The probability of the market coming down and touching this strike is 42. It's a 42% probability of this strike being touched, but only a 21% probability of this being out of, only a 21% probability of it being in the money at expiration, which ultimately we would want this to be in the money, so we could get our full profit on it. But there's only a 21% chance of that happening, but there's a 42% chance of the market coming down and at least touching it. So the probability is much greater. I'm going to take the probability because the odds are against me that it's going to come down there and do that and stay down there. So that's when I look to cover the strategy. As soon as I put this strategy on, the market's trading here, say I do the 31, 25, whatever. As soon as the market slowly goes down there and hits it, I'm out. I don't look at what my profit is on it. I just know that my probabilities are greater that I'm not going to get this opportunity again. Does that make sense? You guys, I mean, your profit's going to be there. If it moves down $3 or $4, you're going to have some good money in that trade. You don't have to worry about it at that point. Oh, well, your defined risk. So Nick, because I'm long this put that is in the money, okay, I have the right but not the obligation to exercise that option. So if I put on this put spread right now and XOP immediately rallies up to 30, I'm just going to leave it on. The reason why is because I've already basically gotten my max loss for the most part. They're going to expire worthless. So I usually just let it ride on the upside if it goes against me. If it goes my way, I'm looking to cover it as soon as I get touched. Does that make sense? No stop loss. No, I don't use any stop losses. Because at the end of the day, Nick, your stop loss, you don't need stop losses with options because you have an option strategy. So you have, it's kind of embedded in there. If you're short, a call or a put, your stop loss would be the long put because they'll offset as soon as it goes against you. Does that make sense to everybody? Yeah, you could get afraid with assignment if that goes below you, but remember, because you're long the option up here, you can assign that one as well and they'll offset each other. Usually what I'll do, and that's another reason, is I don't want to have to deal with all that mess. I usually just cover it when it goes down there because somebody might think that the dividend's bigger than normal or something, who knows. So usually when I get touched on my short, that's when I'm out. So I'm risking the entire debit. But the probabilities of me being correct when I do this enough, where I've doubled my probabilities on the touch, versus just waiting for it to go into the money, then you will win more often than you lose on these because you're rolling the whole probabilities in your favor. Because it goes down there and touches it, it comes back up, you can put the strategy back on again. Keep playing it like that. So when you hit this, Raymond's asking, so when you hit the strike, you sold, that is your max profit. If at expiration, there's still going to be, if they all expired worthless, that would be your max profit. There's still going to be, if we can go to like this and look at here and go to theoretical and change this. Let's just hit reset. So your max profit is going to be achieved when you're at expiration for these February contracts. So on that, as you can see, that's the only way you would get to your max profit is if, let's say we did the 26.30 or something like that, just because I'm feeling like we need to speed up a little bit. But so we go down $2 from 27.60 to 25. So basically, these are right at the money for all intents and purposes, right? They're going to expire pretty worthless. So that's the only time, and you're only going to get your max profit when you're only trading with the intrinsic value of those options. Because remember, our max profit is the long strike minus the short strike minus the net premium we paid for it. So let's say we did a 5 strike wide spread and we collected $2, our max profit is $3 because it's $5 wide minus the $2 credit received equals $3. $3 is our max profit. Does that make sense? So, and that is only when there's only extrinsic value left in those options. So if you're covering this early, you will never achieve your max profit. But, you know, your probability, you know, it's kind of like that, you know, take your, you know when to count your money when you're sitting at the, or don't count your money while you're sitting at the table, you know, however that goes. But basically he's saying, you know when to hold them, know when to fold them. Well, the probabilities, if you're playing cards, the probabilities are the probabilities, and eventually, you know, those probabilities are going to go against you. So that's why I take it. As soon as I can get that touch, I'm out on this strategy. I would say 99% of the time. I have been known to not have that happen. As a matter of fact, I almost covered my McDonald's the other day when it came within 50 cents of my strike. I have on a McDonald's where I'm long the, I'm long the 120 puts and I'm short the 115 puts. And it came down to 15.50 and I almost covered it and I didn't. And I was like, I'm going to wait for the probabilities to work. And of course it rallied $1 the next day. So came back off again today. But that was one of those times where I was ready to pull the trigger and I wasn't nearly at max profit. All right, does that make sense? What's your sweep probability percentage? 80%. Sweep probability percentage being the delta, as I look at deltas as being probabilities. If you watch many of these, I don't know if that's where you're getting that from, but yes, my sweet spot for this strategy is between 64 and 84 is usually what I look at. 84 is one standard deviation away. So right there, 84 is about 84, 86 is about one standard deviation away, which means that only happens about 10% of the time for the most part. So if I'm pretty bearish, that's when I'm going to start going deeper in the money, because for every dollar down move, or for every dollar move, the options are going to be affected by 80 cents here, right? If I'm less sure, I'm going to go closer to in the money, and then those probability, you know, then if it moves up against me or down, I'm only making 58 cents per dollar move of the underlying. Does that make sense? And also the reason why is because, you know, if you're going way up here to this, I'm trying to collect the 50 cents here for these 32 puts. If I go down here to make sure I collect my 50 cents, these puts are only going to decrease in value by 15 cents if for every dollar down move XOP goes. So from 47 to 46, these are only going to change by 15 cents, but these puts here are going to change by 83 cents for that dollar down move. So you're going to capture about 70% of that $1. Does that make sense? Did my screen freeze? Okay, good. Do you put credit spreads on indices? Yes, I do. I do put it. I put credit spreads on everything for the most part. And my credit spreads, I usually am going inside of one standard deviation. My idea with the credit spreads is I like to collect a third the width of my strike. So if it's $1 wide, I like to collect 30 cents. My minimum threshold there is about 25 cents, so 25 to 30 cents on those, and that usually puts me at about a 34 delta. If I'm selling them naked, I'm looking at the 16 delta, which is a one standard deviation move. Does that make sense to everybody? Well, you're asking about I don't have a standard deviation chart, but Leon, so I can't really show it. Fred, you're asking how far out on the indices do I do? I mean, on the options? It depends on what I'm going to do. If I'm going to do, if I'm going to be selling the option, it's going to be naked at around a 15 delta. If I'm going to do a spread, it's usually around 36, 34. Right? Oh, you're right. I'm sorry, you guys. I'm saying 1.5. This is 1.5 standard deviations. 34 is the one standard deviation. That's 1.5. You're right. So 1 standard deviation for the spreads and 1.5 for the naked. Sorry about that. Sorry about the confusion. Does that make sense for everybody? Let's see if I have any more questions here. Exit at loss. Oh, I got up to the top somehow. All right. Does that make sense to everybody? Does anybody have any other questions real quick? Before we go? So for instance, in this one, I would probably be looking at, just to get it straight, I'd probably look to do the 30 and then the 26 on this one. Collect a little bit more than the, get my extrinsic value a little bit below cost for the most part, and take advantage of it that way. It's pretty close, maybe 31.24, probably something along those lines. Does that make sense to everybody? Yes, this is toss. And the ID is constantly updating. It should. You know, it's probably getting a little wanky because it's after the close and it's all gonna get a little funky, I think. Oh, sorry. The delta for the 1 standard deviation, yeah, it's basically the 30-ish, 34 delta is the 1 standard deviation. Sorry about that confusion. 1.5 standard deviation is about the 15 to 10 right in there. All right, so that's how I look at that. I definitely try and get my theta to happen on these more, or at least be equal. I wouldn't want the theta to decay more here than it would here. I want the out of the monies to decay faster than my in the monies. All right, that's about it for you guys. So, you know, takeaways from this, I'd probably be looking at the XOP 3026 put spread and get long that, just to have my risk limited to the upside if anything happens. But I'm pretty bearish on oil exploration right now. As oil's going down, these guys up in North Dakota can't make money if oil's below 50 bucks. And we are a long way away from 50 bucks. And I just saw an oil rig count where they were down by 20 rigs or something. So that doesn't look or bode well for exploration at all at 30 some dollars a barrel. Okay, so you know, here's a membership offer for 1 month, $7. If you look in your chat boxes, there should be a link there for it. You guys can click on that and take advantage of it. We have the daily market commentaries. Almost every day I'm doing a daily market commentary telling you guys what I'm looking at, what I see, you know, whether it's economic, geopolitical, or market kind of talk, and then I kind of talk through why I'm putting on the different trades, what I'm thinking to put on that trade in general. So I go through those different steps. I'm not saying that those trades that I'm putting on are something that is appropriate for everybody. It's what I'm doing. You need to kind of look at it and see if that is appropriate for you guys though. But I do tell you guys all the trades that I'm doing, when I put them on, when I take them off, what price I'm paying for those, and things like that. Why I put it on, why I decided to take it off. And you get the online trading videos, which is an archive of kind of like these webinars, but they're in 15-minute segments where I'm kind of breezing over a lot of things. In these, we really drill down on it and get into the live trading, so to speak, I guess at least the live platform, even though we're after hours. The reason why we do it after hours, you guys, is just so that you guys can make it and can participate in it. I know it's hard during the day when it's trading and you're trying to figure out what I'm talking about for the different strategies and stuff like that. Pay attention to your closing bell. But at the end of the day, we are trying to, get you guys as close to live trading as we can, and then access to these webinars, which is where we're pulling up the options chain and stuff like that. So you can look at that. Osman, you can talk to the home office, and if you guys want, you guys can call into also. You can reach out to us at 310-598-6677 if you have any questions, or you can email us at trading@protraderstrategies.com. You guys, I'm there for you guys. If you guys have a problem where there's an option strategy that is like going against you guys, please reach out to me before it like gets ugly, and I'll tell you what I would do in your situation. I can't tell you what I think you guys would do, but I would tell you what I would do in a given situation. So, take advantage of that if you guys are signed up, because I will be happy to do it. Here's the link. Like I said, that's in the chat box. In later webinars, I'm going to be drilling down on different options components and how to trade those options, trades I find and where I find them appropriate. So I do that on a daily basis in these webinars. I was looking at XOP and EEM to put on today, so might even still do that on Monday, so keep your eyes out for that. Your risk reward is 1-to-1, Chris is asking. It depends. If I have a $5 wide, well, I didn't figure out, you're asking if I buy one XOP at 31, sell one at 24, so the difference there, I would have to see what the prices are. But for an example, just off the top of my head, if I had on a $5 wide strategy, so say a 50-55 put spread, I'm long the 55s and I'm short the 50s. I've got $5 wide. If I collect $2.50, or if I pay, sorry, $2.50 for that strategy, then my reward is $2.50. So that is where you would get 1-to-1, 50-50. Risk one to lose one. On the XOP, that's what, six-ish. Well, I would have to look at it, but I don't know what the prices are and everything on that right now. But that's how you figure it out. So if it was a $5 wide and I paid $2 for this strategy, and my reward is $3. Then that would be a 3-to-2, right? Or 2-to-3. You're risking 2 to make 3, depending on how you look at it. Okay, does that make sense, Chris? So in that instance, if it was $7 wide and it was $3.50 I had to pay for that strategy, then or sorry, $6 wide, $6 wide, and it was $3, then that would be 1-to-1. All right, great, you guys. Thank you guys all for coming out. I appreciate it. I know it's Friday at the end of the our first long week back, and It's been a crazy day. Sorry we didn't get this one out to you earlier to take advantage of the market sell-off, but like I said, I think that this is could see a bit of a dead cat bounce here, and it could still go lower. So Nick, yeah, I'm going to be looking to buy the 30 put and selling the 26 put for that strategy. Something along those lines, I think I was looking at. So it's, $4 wide. So, if you paid $2 for it, you're risking one to make one. But, in that regard, I wouldn't mind that risk reward so much because I'm pretty bearish on it. So I'd be more than willing to do that. All right, guys. All right, we've gone a little bit over. I appreciate everybody sticking around a little bit later today. And seriously, in XOP, that was XOP. It's the oil and gas ETF. And stick around and seriously take advantage of reaching out and pulling on me. You guys can also follow me on Twitter because I do throw out a couple of trades like Bed Bath & Beyond. I threw out my earnings trade for that because I do a daily market commentary, but when I did something at the end of the day there, I felt like I should get it out to you guys or people out there, so I threw it out there. So Bed Bath & Beyond, yeah, they missed earnings on there, but if you watch their earnings webinar, I went through basically the exact same steps I do for that and put that trade on, but I blasted it out on Twitter. So you guys can follow me on Twitter. I'm at Wolfman's blog. All right. That's all I got for you guys today. If you can't take that, take it easy. Have a great weekend and a happy new year. Happy and prosperous new year to you all. Take care.